Welcome back to the Investing on the Go podcast, brought to you by FundCalibre. This week, we're discussing the evolving landscape of Chinese equities, from shifting sentiment and the impact of global energy prices to AI and property market stabilisation.
I'm Chris Sarley, and today we're joined by Dale Nichols, manager of the elite-rated Fidelity China Special Situations Trust. Dale, once again, thank you very much for joining us.
Thanks, it's great to be here.
We had a chat about 6 months ago about all things China, if you remember, and I guess the feeling I got from you was that, you know, while you expected more sort of volatility in the markets, you kind of thought the policy changes had worked to a more sort of medium to longer term. You know, there's been times in the past where they've perhaps been short term and not followed through, but I guess you sort of felt that things were turning and that the competitiveness in the market relative to other markets and the number of opportunities in terms of sectors had improved. But that was 6 months ago, and there's been a lot that's gone on in the last 6 months.
All right.
Has that changed? You know, what's the likes of the oil price with what's going on in US and Iran? What's the, you know, I know you're a stock picker at heart, but, you know, the macro, particularly in China, plays a role. How are things at the moment in terms of sentiment?
Yeah, I think, you know, in terms of market sentiment, it's mixed. It's been a very sort of bifurcated market. You mentioned the policy changes. I'm still, have the sense that the policy is still growth focused in terms of that domestic policy. But there has been some examples of things tightening. You've seen sort of increased regulation around capital outflows. You've probably seen sort of the regulation that's happened on some of the brokerage houses that are doing sort of relying on Chinese customers but operating offshore. So sort of some, I guess, from a domestic regulatory perspective, some tightening, but I do believe there's still very much a focus on growth and improving consumption, and that's still coming through policy-wise around things like around loosening in the property sector and sort of areas like that. In terms of probably the biggest changes in the market since we last spoke, obviously, we've got the Iran conflict and increased energy prices. Hopefully we're near, sort of a resolution there, but that has led to, I guess, more cost pressures domestically. Obviously, from China's perspective, there were concerns at one point about deflation. You've now got PPI that's clearly in positive territory. So, maybe for some looking at the market, that could actually be viewed more positively. And obviously, China is in a better position to deal with higher energy prices than many other countries in Asia. Not the least of which, being that significant investment they've done in sort of building out renewable capacity over the years. And the other big changes, like I guess we see globally, is just what's happening with AI. The capex there, clearly China has lagged in terms of that capex, but there's definitely signs that that's picking up. And at the same time, there's many companies domestically that are benefiting from, the global, sort of rising capex that we're seeing in AI. A lot of companies that benefit, in that supply chain. You're seeing, obviously strong growth in areas like energy storage. China is a leader in the battery sector. So there's many companies, sort of around that supply chain that are seeing quite a big benefit from that. But to sum up, it's been a pretty bifurcated market. The companies that have benefited from that, and that's come through in earnings growth. And then the other sector, the other big part of the market, more domestic focused areas like consumption, where things have continued to remain relatively weak, and those are definitely parts of the market that have lagged overall.
We talked last time about the shape of the market and how, for example, the S&P obviously has done very well, but it's, tied to 7 or 8 big companies. And I think you said that with China, particularly within the sort of the top end, there had been stronger performance in 2025, but a lot of it had come from those leading sort of tech players. Is that still the case, that the shape of it is that you've got this top layer of strong performers and then there's a host of opportunities underneath, even within the larger part of the market?
Yeah, I think less than that type of bifurcation. It's the type of sector bifurcation that's really standing out more now. So again, there are big companies that are benefiting from that sort of capex in AI that we talked about, and potentially improving things in sort of the EV sector as well. So that again, I come to the big battery names and like CETL that are clearly benefiting from that. But at the same time, if we're talking about big tech, we've definitely seen a trend that the companies that are benefiting from the capex are clearly outperforming the spenders themselves.
Mm-hmm.
So you're seeing rising capex from the big tech names, the big cloud providers, Alibaba, Tencent, Baidu, etc. They're definitely increasing their capex. And clearly, the market's taken a dim view of that, because it does have, I guess, the impact to impact short-term cash flows and earnings. Mm-hmm. To me, in some ways, that feels a bit overdone. I think the key question you need to be asking is, will the returns be there on that capex? And the early signs, I think, are that the returns will be there. Obviously, something we need to watch. So, again, I think it's probably, it's better to look at things, by sector and sort of where companies are operating as opposed to market cap. I think that's probably makes more sense.
And I guess, a lot of it does come back to sentiment. And I think, the things you highlighted were those tariff concerns and sort of the need for earnings improvements as the two sort of things that needed to lift to improve that sentiment. I'm trying to remember what the latest is on the tariffs with regards to China. Maybe you could just give us an update on both. I'm quite interested on the earnings in particular.
Yeah, on the tariff side, obviously you've seen a lot of the developments that have played out, and it's still unclear, how things will, sort of play out from the US side. But what I would say is that I think myself and probably most market participants are feeling more comfortable about that.
Yeah.
Not the least of which is, for the reason that it's not just China anymore in terms of who's going to be suffering from tariffs. It's more of a global issue, and probably, if anything, it's probably in terms of the gap between China and other countries, it's probably it looks like that gap looks to be closing. As we've talked about, obviously, Chinese companies have a lot of experience in dealing with tariffs over the years. They're very flexible. A lot of them have taken steps to sort of move production offshore. So I'd say overall for tariffs, it's less of an issue. Your question about earnings is very valid. And that's sort of been, again, if I think about China versus the US market, that's an area of weakness because generally we've seen revisions downward in China. I do think the ingredients are there for things to improve, and I'm sure we'll talk about things like the property sector, where I think there's clear signs of stabilization. And then if we have that, there's still a consumer that's sitting there very cashed up, having underspent for years, really. So that combined with the type of AI spend that we talked about, we sort of see the contribution to overall economic growth that's providing in the US. Obviously, that capex cycle, has been much smaller in China, but again, the signs is that's accelerating. So that combined with the fact that pretty much all companies are doing more offshore. Mm-hmm. For the companies that do have overseas businesses. And in most cases, given the competitiveness of the market domestically, they make better margins offshore. So that's a factor as well that I think can, slowly contribute to better margins and hopefully a better earnings outlook as well.
Okay. I wanted to touch on property. It's a bit of a dirty word whenever someone talks about China, but again, back to that previous conversation we had, obviously there were significant clouds, but you sort of felt that while there was a challenge, that there were some pricing opportunities at lower levels within that sector now. Has that still the case 6 months on?
Yes, absolutely. I do think there's opportunity there. Obviously, a very out of favor sector, and that's what's helped drive multiples to these very, very low levels. At the same time, as I've said, there's signs of stabilization. Obviously, mostly in first tier cities, but in recent months, definitely month-on-month increases. That hasn't translated to a year-on-year increase yet, but I'm hopeful that can play out at some point. As I've said, the government is doing more to support the market, but more importantly than that, you've seen a significant supply adjustment.
Yeah.
And obviously, demand has been weak for years. So I think just from a pure supply demand perspective, there's good potential for pricing to start to stabilize. And you've got very, very cheap companies, very out of favor sector, and a lot of, in terms of the way the market's looking at these companies, there's quite a few companies that have significant investment businesses. And my sense is the market's definitely not valuing those businesses as it would in other markets. Clearly a lot of these businesses, you've got some very good operators, particularly in areas like shopping malls, that are clearly outperforming the overall consumption environment in China. And yet, my sense is the market's valuing more like the developer part of the businesses, which are clearly not the same quality. So, that's actually creating, I think, quite a bit of an opportunity in the property sector currently.
Okay. And there were 2 or 3 areas that you were sort of keen on that I just wanted to maybe touch a minute on each possibly. And they were sort of industrials, healthcare, and you've touched on it earlier there, the consumer. Are they the most promising areas in the market still, or has that changed in recent times?
I think definitely, those are promising areas, but for quite different reasons. Industrials, for everything that we've talked about. There are many companies that are benefiting from the sort of capex spend that we've talked about. And as I've mentioned in the past, I still have the sense that the market doesn't fully appreciate the competitiveness of many Chinese companies, just given the scale of their businesses, the investments that they've made in R&D over time. There's just really very few sectors where Chinese companies in these areas are losing market share. They're generally market share gainers, and as we've talked about, as they go offshore, they're getting better margins. The other 2 sectors that you mentioned, I'm quite positive, but it's the valuation element is a much bigger factor in being positive. So these are quite out of favor sectors. So sort of as we've talked about, in consumption, sentiment has been weak. There's signs that it's gradually improving. The hope will be that, with the property market stabilizing, you can, slowly get a sort of better consumption environment. At the same time, there are still real growth areas within the Chinese consumer. I mean, think a decade back when we were all talking about the Chinese consumer and the potential there. A lot of those fundamental stories are still very much in play. Think about areas like services. Obviously, areas like travel have pretty significant growth potential. On the goods side, thinking about areas like sportswear, where your per capita spend is a fraction of what we see in the West. And that's there's still real structural growth stories. Combined with, as I said, the potential for things to slowly improve and very low valuations and weak sentiment. So I think there's potential there. The healthcare sector is a bit bifurcated. We've seen some decent performance in the more innovative drug areas. And I think that's justified. Obviously, there's a huge amount of innovation that's happening in that space. That's been recognized by global pharma. They're beating the door down to China to license a lot of the novel drugs that are coming out. There's been weakness elsewhere in the market. The hospital area has suffered. There's been clearly funding issues that have been a headwind there, and pricing issues as well. And that's driven sort of valuations to very attractive areas. And, clearly anti-corruption campaigns and that sort of thing haven't helped. But our sense is, that sort of the bad news flow there is probably coming to an end. And with valuations where they are, that part of the market also looks increasingly interesting.
Are you, to put it as a simple question, are you finding lots of opportunities within the domestic market in terms of A shares and also the unlisted space as well? Maybe just give us an example, particularly on the latter, if possible.
Yeah. Clearly the A share market has definitely outperformed H. And a lot of it's for the reasons that we talked about. You've probably got a more export-oriented sector, which is, there's a lot of, there's decent trends there. We talked about the big tech names that have lagged the market as well. So it's that balance again. It's you've got probably stronger fundamentals, earnings growth in the A share market, but just not as attractive valuation. So it's a mix, in terms of the portfolio. On the private side, there's quite a bit going on. There's things that we continue to look at to add to the portfolio, and I'm hopeful that we'll see sort of new names come into the portfolio in the next 12 months. Obviously it's an important part of the portfolio. ByteDance is our biggest holding there.
Yeah.
And the performance there continues to be very strong. And that's what's sort of driven some of the revaluation, the revaluation of those shares. My sense is that there's still quite a way to go there. I mean, despite the very strong earnings, you've still got the overseas business, i.e. the TikTok business, which is really not contributing. In fact, it's been a drag to earnings. You can justify the valuation that many are using based purely on the domestic business, which means you can take the view that you're effectively getting 2.1 billion users through TikTok at very low valuation, if not nothing. So I still think there's real good potential for value there to be realized if they can monetize to any extent that they've been able to do domestically.
Okay. I appreciate this is a bit of a sort of crystal ball question, but it kind of just is quite interesting with that pivot in September 24 or whatever it was with the policy changes. Do you think that, however long this was, 15 years it's been running now, the portfolio, do you think that leans towards those pivots and that pro-growth stance being really cemented, leans towards the A shares and unlisted market in terms of your exposure? Do you think you could see yourself putting more in there because you've got the underpinning of government support now to perhaps a more of a concrete sort of level?
Yeah, I think. I mean, I think that policy shift. When I think about the sectors that are going to benefit or should benefit mostly from that, it should be those areas that have struggled. Property, consumer, etc. And that probably plays more into the H part of the market as opposed to A. That's probably again consumer, property, or at least where I think in terms of my holdings in the portfolio, it's probably more concentrated in that H share part of the market versus A.
Okay,
and versus private.
Okay, and I guess just one more thing. So the trust has sort of grown its dividend every year since launch in 2011. I think it's compounded at over sort of 30% now. Do you think that increase in corporate focus from China, is it just the tip of the iceberg? Do you think that will keep improving in the future now?
Yeah, thanks for pointing that out. It's something that in terms of capital return, it's not talked about enough when we're talking about China, and obviously we've benefited, as you mentioned, in the trust from increased payouts and buybacks from companies. And my sense is that that momentum is strong. In terms of the discussions we're having with companies, that the capital return discussion is central to a lot of what we're talking about with companies. Obviously, we're happy for companies to go ahead and invest when they see the the potential in the returns, but otherwise, we in terms of running efficient balance sheets, we're happy to see it come back to us. And I think the momentum there is strong. I might not be as positive on the outlook for buybacks. Obviously, we've seen really significant buybacks over the last few years, particularly when the market was very out of favor. So the companies were buying back a lot of stock now. But I still think the buybacks will be significant. I'm not sure if it will be as significant as we've seen over the past few years, just given, again, stock prices are higher from where they were. And then for many companies, the CapEx needs are rising. Which, hopefully, that leads to better returns and earnings for the companies. But maybe less in aggregate buybacks looking forward.
And I guess I just wanted to finish with sort of a direct message to investors, really. I mean, your trust is sort of known for that small and mid-cap bias, and it's very sort of obviously clearly it's all about stock selection.
Right.
Do you feel like the way things are sort of moving is leaning towards your investment style again, or am I being too optimistic for you there?
Yes and no. China has always been a great stock picking market. It's very volatile. It's driven by the headlines, in many cases, as you know, and that can create real opportunities. There's a lot of the market that's not covered. So it's great that we can leverage, the team that we have on the ground to find those ideas. At the same time, as I've said, we're sort of in a market that's very driven by some big trends.
Yeah.
I think, as you mentioned, stock picking has been, a really key driver of performance over time. You can go through periods where the thematic is more important as opposed to sort of, great management teams really executing on their strategy. So I think there's an element of the market that is, sort of, playing the trends, so to speak. Those big trends are sort of, many companies sort of riding that wave. But over time, management is key, and I think that's a core part of stock selection, and I think it will shine through over time as it has up to now.
You sort of segued into my last quick question, which was patience. Is this the sort of, in your tenure on the trust, is this the most patient you've had to be with those stock specific focuses, with all the stuff that's swirling around China? Has it been a case of just being patient more than anything else?
Yeah, I think. Definitely in some sectors, we've talked about sort of the holdings in areas like consumer, but that's often the case in markets. Markets, it can really take time for the market to recognize the performance of good companies. But, again, as long as the earnings are there and the valuation is there, the market will get there as well. So it can take time, but, we do benefit from inefficient markets. That's pretty much what the stock selection process is about. So, I kind of feel like, that patience has been important really the whole time.
Okay. On that note, Dale, thank you very much for joining us once again and explaining all things China to us today.
Thanks so much.
This trust invests predominantly in companies listed both domestically in China and Hong Kong, but can also invest in Chinese companies listed on other exchanges around the world, as well as companies with significant interest and primary revenue exposure in China. To learn more about the Fidelity China Special Situations Trust, please visit FundCalibre.com, and don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts.
Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.